once again, it's time for another homework tutorial. This time, Unit 4, we're going to be doing some valuation problems in Excel. So let's open up the Unit 4 homework Excel spreadsheet. I've got everything templated here, pretty nice. So this will be pretty quick and easy once we know how to work the basic problems. And you'll notice I've got a selection of textbook problems from Chapter 12 here, and then a few problems of my own creation, which I actually created for some MBA students, and I think we'll tackle those. Actually, not too difficult. Okay, so starting off with 12.1, page 315, it says Owen Meany is considering the purchase of a $1,000 Amity Island municipal bond. The city is raising funds for a much-needed advertising campaign to promote its East Coast resort community. The stated coupon rate is 6%, paid annually. Let's go ahead and start plugging stuff in here. 0.06, which we can format as percent. The bond will mature in 10 years, so that's going to be our INPER. And the yield for maturity for similar bonds in the market is 8%. 8%. So what should we use to discount this bond if we're trying to value it? We should probably use the 8% rather than the 6%. Now the 6% will tell us what the coupon is. It's got a face value of 1,000 and it's paying 60% interest. I know that's $60. If you can't do that math in your head, just do this 0.6 times 1,000. Whoops, let's try that again, equals 0.06 times 1,000. So there's my coupon, and that is dollars. And the future value is going to be the $1,000 par that we get at the end. And let's go, remember I said when in doubt, go with 0 into the period. Okay, now, question A actually just says how much are annual interest payments? Well, that is the coupon rate, 0.6 times the face, okay, which we calculated already, and we plugged into our structure for our function. The book just wants us to address it separately here. Then what is the market price of the bond today? Okay, that's where we're going to run the present value calculation. And we're just discounting that bond's cash flow payments of $60 and then principal payment at the end of $1,000 over a 10-year period at 8%. So use our familiar present value formula in the structure within Excel. Future value type. So let's make the payment negative, and that'll make I've got to make the payment and the future value negative. That'll make the present value positive. So we're valuing this bond at $865.80. And remember that why is that the case? Well, because the original interest rate was 6%. Interest rates have since gone up to 8%. And when interest rates go up, remember the Bocephus principle, asset values go down. And that's what happened here. It went down from its face value of 1,000 to 865. Okay, so the market price is this. And then question C, it says, is interest received on a municipal bond generally tax-free? Yes. Okay, now 12.2 is a very similar problem. I'm going to let you do that one on your own. I will just give you a pointer here. We've got a corporate bond of 1,000 face value, coupon rate of 12%. So remember, coupon rate of 12%, that's going to determine the payment, 12% times the $1,000 face value. Okay, and then the actual rate we're going to use is again 8% to discount. So don't accidentally put the coupon rate in here unless the coupon rate happens to be the same as the current market rate. But what we want in here is the current market rate. The coupon rate is going to determine the payment. So notice that difference. And in this case, the coupon rate was 12%. The market rate has gone down. So what do we expect to happen to the value of the bond? Remember, inverse relationship. If interest rates go up, or I'm sorry, if interest rates go down, the market value of the bond is going to go up. The only difference here, so you can run that yourself. The difference is going to be, says what would the present value of interest and principal paid to holders if one of their bonds, if the interest payments are made semi-annually instead of annually. If we're going to do this semi-annually, we're going to divide the rate by 2, and we're going to divide the payment by 2. So the payment will be 60, and then the number of periods is going to be, instead of the 15 years, what we'd have over here, it's going to be 30 periods, 30 payment periods. And when you work that problem, you'll see that there's a slight difference in valuation based on that higher rate of compounding. All right, so I think you can handle that one. Now, let's move on to 12.6. And 12.6 and 12.7 are very similar, so I'll show you how to do it in 12.6 and then let you take a crack at it in 12.7. The book template, some of these, the book provides templates, some I created the templates, but this one gives you some instructions if you need it, but we can just jump right in. So let's go down here. This one's highly structured for us, so it's pretty nice. All we have to do is really enter some things and just let it rip with Excel. It says Clancy Submarines Inc. is offering $1,000 par bonds for sale. The bonds will mature 10 years from today. The annual coupon rate is 12%, with payments to be made annually. James Hobson just purchased one bond at the current market price of $1,125. So let's enter everything in. Par value is 1,000. Coupon interest rate, remember, was 12%, 0.12. Market price today is $1,125. All right. So what this template did was give our string of cash flows. Time 0 when we buy the bond is the outflow of what the market price we paid, so that's a negative 1125. For every year up till the end, we have the interest rate times the par value, so there's the coupon payments of 120, and then at T10 we also get the principal, so we're adding the par value back plus the coupon. So there's a string of cash flows for the bond. And then what we can do to value it is just use the net present value formula, which is actually already pre-built for us as well. So net present value of the first cash flow, the outflow, and then the string of cash inflows at the appropriate rate, which we're using. We're gonna have to. That's what we're gonna have to come up with ourselves. We're gonna have to enter something there. So what the problem's gonna have us do. Well, first off, in part A, it says, will the yield to maturity of this bond be greater than or less than the coupon interest rate? Answer this part without doing any calculations. How do we deal with that? Well, look at the price compared to par. The price went up compared to par. What does that mean? What happened to interest rates? They must have gone down. Remember that inverse relationship. So interest rates have gone down, and that means we're going to discount it at a lower interest rate. So I'm going to say the yield, and it's going to be priced according to current interest rates. So I'm going to say the yield has gone down. Yield declined due to fall in market interest rates. I'm being a little more detailed than you maybe need to be, but I want to explain why. Okay, so now we can just plug in, we can start guessing values, and I know it's going to be less than 10%, so let's try less than 12%, let's try 10%. I need to get this net present value to 0 to find this rate of return. So 10% doesn't work. 9% is getting me close, but it's got to be a little bit less than that, 0.875. Okay, so I could keep guessing, and whoops, not 87.5, 0.0875. Okay, I could keep guessing and guessing, and I'd eventually get there, and I'd probably not get it quite actually to 0. So let me show you a little trick or a little tool that Excel has that will calculate this for us. Up in Data tab up here, we want to go to What If Analysis and Goal Seek. And Goal Seek's pretty cool. It's a guess and check procedure, but Excel can do it very rapidly for us. We want to set our net present value to 0 by changing that, and Excel will just do an iterative guess and check trial and error process and rapidly solve for us yield to maturity of 9.968%, which, you know, we could round that up a little bit, 9.97%. Okay, so use that that goal seek procedure. If you're not familiar, the note here on the cell tells us how to do that, and you can go back and rewind the video, watch me do that again, and you can apply the same procedure to problem 12.7. Get that net present value to 0. That'll give us the yield to maturity when the bond is priced properly. Back to 12.6 really quick. It says, what would the yield to maturity have to be to make the market price of the bond equal to the face value? Well, if the interest rate neither rose nor fall, there wouldn't be a premium or discount in the price, so it would be trading at par. So it would be the initial coupon rate, 12%. Actually, the price would be $1,000 to correspond with that. So if the interest rate hasn't changed, the bond price hasn't changed, and that means the yield on the bond would still be 12%. Okay, so you do 12.7 on your own. And let's move along. 1211. Okay, now we're dealing with some stock valuations, and this is a formula I don't think we covered in the lecture, but it's pretty straightforward, so I think we can tackle it here. And I've gone ahead and copied the formula out for us. We're looking at stocks that pay dividends and then have a assumed constant rate of growth in the dividend. So it might pay $1 per share dividends in year one, and then we're going to assume that that dividend grows by 5% per year. So the next year it's going to be $1.05, and then the next year it's going to be $1 and 10.5 cents, so on and so on. So the dividend's going to have some compound growth too. So that means the stock value is going to benefit from that growth rate going off into the indefinite future. So this one says 1211 says China S Construction is in the business of building electrical power plants in the eastern U.S. Jack Godell and the rest of the board members of the firm have just announced a $4 per share dividend on the corporation's common stock to be paid in 1 year. Because the quality of some of its recent projects is under attack by investigative television reporters, the expected constant dividend growth rate is only estimated to be 1%. The required rate of return for similar stocks in this industry is 16%. A. What is the present value of the expected dividends from 1 share of China S Construction common stock? Well, here's the formula. Present value today, P0, that's the value today at time 0, is equal to the dividend, D1, in the first year, divided by R, which is the discount rate, minus G, which is the dividend growth rate. So let's plug everything in and then just run that formula in Excel, just using Excel math. So the dividend is going to be $4. The rate of, the discount rate, remember, this says required rate of return, that's a discount rate, for stocks in this industry is 16%, 0.16. And then the growth rate of dividends, they said 0.01, a pretty small growth rate. Okay, now we can run this formula in Excel. Equals D1 divided by, use brackets because we've got a addition problem here, RS minus G. And there we go. We're going to value this stock at $26.67. And then part B says, what is the stock's dividend yield? Well, it gives you the formula in the book, D1 divided by P0 equals D1 divided by P, which is present value, 15%. All right, 1213 is a very similar problem. You can work this, and then part B is a little challenging. It asks for the rate of return. I'll challenge you to see if you can work that out on your own. If you can't, don't worry too much about it. I'll put a very low point value on that, but I'll see if you can work that rate of return. You can turn back in the book, and the book will help you figure that. Okay, let's move on. And then I've added, to wrap up this assignment, some problems I created, as I mentioned, for some MBA students. I think we can tackle them. They're using the same principles of valuation and the same Excel functions that we're getting used to now. So let's dive in here. And this is one of my favorite ones. I've had some experience in real estate, so I like to think about real estate valuation problems. So we've got A up here. Let's read in the text box. A rental property is expected to earn $9,600 yearly net income, and we've already figured out the cost of maintenance and repairs. So this is the net rental income. You expect the unit to last another 20 years before needing total replacement. That is, its value will depreciate to zero after 20 years, and that does happen with properties. You have to keep in mind that the weather and wear and tear are constantly destroying them. So eventually you got to figure, you don't need total replacement, but you're going to need to spend a lot of money to keep that thing maintained. If your opportunity cost of capital is expected 7% real return on stocks, which I've mentioned before, and I think that's a good discount rate to use, kind of a good benchmark rate, because we're talking about a long-term investment in rental property. Well, what's your alternative? A passive long-term investment in stocks where you don't have to do maintenance or deal with unruly tenants, right? So at least 7%. You might want to tack a few extra points on for the risk and hassle of the rental property management. But anyway, let's just start with that 7% as our basic discount rate. And then we're going to use Excel's present value formula to calculate the capital value, which is the present value of the property. Okay, so let's move down. Now we're going to do that over here in A. The threshold rate, 0.7. I've already got that as a percent, so just type in 7%. Asset lifespan, we said, is 20 years. The expected income per year, $9,600. and then this future value. We're going to go ahead and let's just run that as 0. Now it's actually not going to matter too much, and I'll show you if we think the property will be worth something in 20 years, because that's so far into the future, it's going to be almost all discounted away at our discount rate of 7%. So let's run the present value now. This rate, that number of periods, that payment, we should be getting very familiar by now, right? And I can actually just close this up. If I leave future value and type blank, it just ignores them. And so we get a value of 101,000. Let's make that positive. All right, so if this is a prospective purchase, I say it's worth 101,000 at a rate of 7%. If I can get it for 80 or 90,000, maybe a good deal. If they've got it priced at 120,000, walk away, right? Bad deal. In fact, if they've got it priced at 105,000, it's a bad deal. Remember, I said we might want to add tack on a few percentage points of return to make it really worthwhile. And at that point, we say, it's maybe only worth 80,000. Now I want to pay 80,000 max and maybe try to get it for 70. Then it'll be a good deal for me. So this is why I like Excel, as I've mentioned, because you can just play with the assumptions here. What if we think it will have some residual value, 50,000? In that case, I do have to go ahead and tack that into the function. Okay, so that changes the value a little bit. If we go from 0 to 50,000, that'll add another 10 grand or so. So just assumptions we can mess with. But let me go back to what we had to start with here. Okay, so 101,000 is what we should get based on all the assumptions up here. Now let's move to part B. What is the maximum amount you would be willing to pay for renovation that would be expected to increase the useful life of the property by 20 years? Okay, so now we're going to say everything here is the same, so I'm going to be efficient and just copy and paste it, but the difference is I'm going to put 40 years in instead of 20. Whoops, 40 years up here. We're still going to depreciate it all the way. There we go. So 40 years instead of 20, still have a future value of 0. And so what's the impact on the present value? Well, we go from 101,000 to 127,900. So we get about a, $27,000 increase. Well, that means it'd be worth doing this if I could spend less than the 27,000. If I could do the renovations for 10,000, I get 26,000 in extra present value. That's like a current net realized profit of 16,000, so I would do it. If the renovations cost me 30,000, I'm spending 30,000 to get a present value increase of 27,000, 26,000. It's not worth it. So what's the maximum amount I'd pay for renovations? Quite simple. I'm going to take the present value, the capital value with the renovations. I'm going to subtract from it the capital value without the renovations, and there we go. It's just that difference in valuations. Like I said, if we can do those renovations for 15,000, they're going to create 26,000 worth of value for us. And this is how you want to think about spending and investing in this kind of project. You need to make an apples-to-apples comparison. Discount the results to today, so we can compare present value in situation A versus situation B, and then make a wise decision on that basis. Now, of course, a lot of things could change, and if we think there's more risk, what do? We dial up these interest rates, these discount rates. And we can see the difference there. The higher the interest rates, the less we'd be willing to pay for those renovations, because the higher the risk associated with the project. The higher the interest rate gets, the smaller that differential gets, and the lower my value here for the maximum payment for renovations. Okay. Let's do one more twist on this, part C. What happens to the unit's capital value if easy monetary policy enacted by the Federal Reserve can successfully reduce broad interest rates and hence equity yields by 1 percentage point? Revert to the 20-year useful life expectancies in part A. So let's copy over part A over to here. Let's dial these back to the 7% initial yield. And now we're saying instead of 7%, we're saying let's expand that. Interest rates go down to 6%. Now what's going to happen to that capital value? Interest rates up, stock market's down, the inverse relationship. That means if the interest rate's down, the stock market, and generally speaking, all assets are up. And indeed, it goes up to 110,000 instead of 101,000. What's a percent change? That's just simply going to be the difference, the growth from here to here, divided by the initial valuation. So I got an 8% increase. Interest rates fell by 1 percentage point, What was the reduction, by the way? You don't have to do this. I'm just going to show you what was the reduction in interest rates. It was -1 divided by the base, which was 7. Got a 14% reduction in interest rates. There we go. I got a 14% reduction in interest rates, and that created an 8% increase in capital values. So a pretty strong effect there. Just a 1-point reduction. Give me an 8% increase, a 14 percentage reduction in interest rates. Bocephus principle. That's why the Federal Reserve can kind of boost the economy if they want by reducing interest rates, but they can also create overinflation of asset values, and maybe that hurts the economy in the long run, as we saw unwind in the 2008-2009 recession. So a very dangerous and powerful thing is monetary policy via its effect on interest rates and the interest rates' effect on asset values. Okay, finally, there's two parallel problems here, and I'll work one, and then I'll let you work the other on your own. I'm a big PBS fan, or I shouldn't say fan. I just watch it because I'm too cheap to pay for cable. But anyhow, interesting programs on there actually, and one that I like to watch is Antiques Roadshow. And so people bring in their antiques and see if they're valuable, and sometimes the antiques are quite valuable, tens of thousands of dollars for rare vintage items, furniture and art and things like that. And then the appraisers usually ask, well, what did you pay for it? Well, I bought it at a garage sale for $100, or I bought it at an estate sale for $50. And it seems like if you bought something for $100 that's now worth $1,000, that you did well on it. But what if that was 20 or 30 years ago, which it often is? I bought this. My grandpa bought it in 1950 for $50. Well, what else could you have done with $50 in 1950? You could have put it in the stock market and earned a 7% real return for 67 years. So what looks like a good return, and the appraisers on Roadshow actually often say, oh, you did well on that. Well, did you really? Let's do some finance math on that and check. So there's two made-up scenarios here that are kind of based on what you would actually see on Antiques Roadshow. What we're going to do is find these people's actual rate of return on their, quote, investment in their antique. So let's just start off. The first case here is A and C. I'm going to do two different scenarios, and then the second case you'll do down here is B and D over here. So this one says Mary Louise Salas bought a Federal period chest from an antique store in 1975 for $800. In 2005, 30 years later, Lee Keno appraised it at $8,000. Wow, that looks like a big growth, right? But let's see what her actual return was. Calculate Mary Louise's rate of return, assuming she sold the chest in 2005 for the appraisal value. Okay, so the number of periods is just the number of years from when it was appraised, 05, to when it was bought, 1975. So I know that that's 30, but if you want to just check yourself, just do it mathematically. 2005 minus 1975. 30 years. The payment, there's no payment. We're just talking about an initial investment and then a lump sum at the end. So the present value was 800 in 1975, and then it was 8,000. That's the future value in 2005. And now we can just run our rate calculation. Number of periods, payment, present value, future value. Type, let's go ahead with 0. Actually, I don't think we need to enter anything else. The things that are in brackets here are optional, so let's see if Excel can calculate. Excel, I forgot my own note here. Present value must be entered as a negative number for Excel's rate function. Let me highlight that for you. Present value must be entered as a negative. I forget that often, but then I remember to fix it. Okay, she got about an 8% rate of return. If our long-term benchmark rate is 7% on stocks, then maybe she did okay. However, we have to make an adjustment here. Let's look at C, part C right here. In case A above, $800 in 1975 had the same inflation-adjusted buying power as $2,900 in 2015, and let me prove that for you. Okay, and we said $800 in 1975. This is a nice little tool that allows us to assess the effects of inflation. Has the same buying power. Now we're back in 2005 now, so let's go back to 2005. Let's make it the same month. Let's just go with January. Okay, 29.28. So what's going on there is that the dollar used to be worth more because its value has been eroded through inflation. So if we want to put $1975 in the same buying power level as $2005, it'd be almost $3,000 in 2005 terms. So 29.28. The problem, I said 2,900. I just rounded it off a little bit. So what should we do here? We should actually, to put things in commensurate terms, we should say the original purchase price was 2,900. And it still grew to 8,000. So now what I've got here is apples to apples 2005 dollar values. So what she purchased it at in 1975 was equivalent in 2005 to $2,900. Okay, everything else is the same, 30 years, no payment. And then I want to run that rate function again, but now with this, whoops, not 300 years. Let's fix that. There we go. And no payment. And actually what I can do efficiently is copy this over. And oh, that makes the rate of return fall to a paltry 3.44%. So was that a good investment? Well, she could have got 7% if she just would have put the money in stocks. So if you're looking at this from an investment perspective, it's actually a loser. If you could have got 7, but instead you got 3.4, did you win? No, you actually lost. Okay, so not a good investment in this case. Now, I'm not saying she shouldn't have bought the chest. She might enjoy the furniture. You know, she might be a collector. That brings her some other satisfaction, so that's fine. Just don't be fooling yourself that this is a good investment when its inflation-adjusted real rate of return is less than what you could have gotten in alternative long-term investments. So do the same thing for Bud Simonson here with his 1931 Frankenstein poster, and I gave you the inflation-adjusted amount, so you'll do the inflation-adjusted calculation over here. And then in part E, I want you to comment on whether these people had a good investment or not. And remember, that's compared to the alternative, which for these longer time periods, you ought to be thinking about stock market investments. Stock market investments are risky, but over the long term, they perform well, and that volatility washes out in the end, and you're going to earn something like a 6 or 7% real rate of return.